Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to be discussing some of the most interesting financial market themes that I'm observing. So today's topics ahead of the big holiday weekend, fastest stock market recovery on record with the S&P 500 back to a new all-time high. In terms of the fixed income market, we got a strong jobs report on Thursday. Yield curve compared to the beginning of the year has steepened, and we'll discuss some of the implications and what's driving that. And finally, markets are all-time highs, but market breadth, the overall participation is also extremely positive. So on the chart here, or table rather, going back to 1957 or 1950 rather, you can see all the periods in which the market had a 15% drawdown or more in history and how many trading days it took for it to recover and reach a new all-time high. And you can see going back to 1950, the average length was 355 days. There were some outliers there during some of the major bear markets there in the late 70s, financial crisis, and post financial crisis, rather. But when you look at the overall averages compared to today's rally of only 55 trading days, it is first place. You look at the late 90s, and 98 was the only one, 98 and early 80s that were somewhat comparable. And that rebound marks the fastest recovery from a 15% drawdown on record. And when you look at some of the drivers, you really have to point to the de-escalation of tariff war and negotiation or conflict, rather. We also had the mid-year tax bill and some of this economic data that continues to say the market or the economy is just really trudging along and doing a little better than most expected at this point. Now, in terms of the fixed income markets, on the chart here, we have two lines, and the teal is where the yield curve was at the beginning of the year, and in the green, it's where the yield curve is at right now. And of course, these are basically just the yields at each one of the respective maturities that are shown at the bottom of that chart there. And the yield curve is steepening really as markets anticipate growth over the long term, a potential resurgence of inflationary pressures that we've seen in Q1, even as the Fed has cut short-term rates, most of it last year. When you look at some of the drivers for this, number one, we entered this Fed rate cutting cycle with the yield curve heavily inverted on the long end. So as the short end has come lower, that long end wasn't extremely high to start with. You also have the fact that fiscal debt continues to increase. We have the bill that's likely to be passed or is already passed here this weekend, and expected Treasury issuance, which is going to continue to, if you're selling, put upward pressure on interest rates, and also tariffs to the extent that that has de-escalated and decreased the odds of a recession. Those long-term rates are staying pretty stable, even though short-term rates have come down in the past few months. Historically, that's typically what you want, is that steepening yield curve, and that's what we've seen occur in the bond markets. Now, market breadth is extremely positive. On the chart here, we have the NYSE Composite Index in the teal and the NYSE Advanced Decline Line Index in the dark blue. And the one takeaway is that both of them are all-time highs. The NYSE Advanced Decline Line is essentially a running tally of advancing minus declining issues each and every day. And what we're seeing is this is confirming that there is broad participation across all sectors that is signaling healthy internals and really reduces the risk of a top-heavy market. And even though the Mag 7 and the tech stocks have led during the past few weeks and have really taken back their leadership role, these types of indicators tell us that there are also a lot of stocks across the market cap spectrum and sectors and industries that are also participating. We've also seen small caps pick up the big laggards for the past year and a half during the second half of this week going into that jobs report. So that is all pretty good signs from a technical perspective of the internal strength of the stock market. And finally, I want to thank everyone for watching. Wish everybody a happy 4th of July. Not to put any damper sort of the parade, if you will, but when we look back to the Declaration of fun little fact, interesting little fact, the Declaration of the of Independence was authored and sort of signed off by some members on July 4th, but actually most members that signed that declaration actually did it in the weeks following that. It wasn't until actually early to mid-August where they had all the signatures on that document. So it was formally documented July 4th, but it actually wasn't finalized till late August. I wouldn't let that get in the way of having a good time with your family, whether it's parades, fireworks, all the different events that they have within your local communities. I want to wish everybody a great holiday, and we will see you in a couple weeks.